This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I always like walking into these unexpected conversations, and I always like getting ideas for good guests from prior guests. Jerry Parker, one of the turtle traders, someone who's been on this show quite a bit. Jerry recommended my guest today, Alan Dunne. He is the CEO and founder of Abbey Capital. Alan's been in the markets for 25 plus years. He's seen it all from global macro to managed futures. Got started in his career as a foreign exchange analyst. He was at Bank of America, London, Hong Kong, Singapore, been all around the block. Just one of those interesting conversations where you get behind the scenes and you see a different perspective, a different way on how someone got to the end goal. The end goal being some success in the markets. Without any further delay, let's jump right into my conversation today with Alan Dunne. Alan, as I was thinking about today, and I think you're a perfect guy to have this opening question. I'm not really sure it's a question. It's just a thought that I'm having right now as I'm watching the world unfold here, and let's put a date on it, in May of 2022. You've been around the block long enough, and so have I. We can both recall what happened during the dot-com bubble. We have a big run-up, and then it goes down big time. We get to the fall of 2002. Things have not really done very well. We've had a 2-year stretch down. The NASDAQ's bottoming out, minus 77%. But we all know the story because we all saw the movie The Big Short, and we know what the Fed did. They dropped those rates down. Appetite for risk in America. Let's push up housing. Let's push up stocks. Everyone knows the end result of that. We get to 2009. There's a little hanky-panky. All of a sudden, equities start taking off. Risk on. Then we get something like Bitcoin. Everything's just rolling for a long time now, 14 years. Wow, huh? We get to that moment where all of a sudden it's starting to feel like, I'm not trying to draw any kind of parallel here. It's the same feeling that I had in the bottom of '09, where it seems like now the pattern is, here comes the Fed. Things got too high, too extended. Let's start raising rates. And then all of a sudden we know what happens when the rates go up. Is this an organized effort over the last 20 years to restart things and kick the can down the road? You see where I'm going here? I don't hear people talk about these three events where they seem to be connected at the hip.
I think it's interesting. One of the things that's been interesting about the current market environment is, if you go back to COVID, everybody said, this is interesting. We had the Spanish flu in 1918. What followed that was the Roaring '20s. People are always looking back to the parallel in history. Obviously now, the 1920s analogy seems to be pretty superficial, really. The other thing that's been going on has been inflated asset market. The parallel with that has been the 2000 period, as you say. I think what we've got at the moment is a market environment that is similar to that 2000 period. We've had growth stocks that have been very inflated, are now deflating. The question is, will the playbook be exactly the same? The difference this time around, you've got a dual problem that the Fed is trying to respond to inflation that is much higher than we've seen in the last few decades. And the starting point is really negative real interest rates. I think the playbook will be a little bit different this time round. The question is, one, how quickly will the Fed go from tightening mode to easing mode? And will inflation come down to allow that? I think those parallels are interesting. But I just wonder, and I think this is the question in the market's mind, is that now are we shifting into a scenario that this time round the response can't be exactly the same? That's where the whole idea of we have to think about the parallels with the 1970s, whereby every time the Fed tried to tighten policy to impact inflation, they didn't really have the gumption to follow through. Then they'd go back and ease.
You mean to follow through like Volcker followed through?
Yeah, if you go back to the 70s, there's a famous speech that Arthur Burns gave in 1979. He had finished being Fed chairman then, and he kind of lamented the poor performance of central bankers over that decade. He put it down to the lack of political backing to really get inflation out of the system. We're in an interesting spot now. If you go back to the start of the year, you had Democrats in the US calling for tighter policy to address inflation. The question will be, if you get into a scenario where the Fed tightens, you get a recession and we're already into a significant decline in equity markets, will that political capital still be there to continue to keep policy tight if you get a recession and really try and wash inflation out of the system? That's what may be different this time around versus the 2000 period and even the 2008, 2009 period.
The inflation adds the extra caveat that there's nowhere to hide.
Absolutely.
I'm curious, though, in terms of thinking about if then, okay, the Fed's raising rates. You and I, we're not really trying to make predictions here at all. We're just having a conversation about how things might go and how things have typically unfolded. Okay, right now the Fed's raising rates. How high will they raise rates? Back to the Volcker issue. Will they get inflation under control? What other options could they have, though? Would it just be more of a kick the can down the road as you point to the 70s style and things never unfold exactly the same? Instead of squeezing that inflation out, we could imagine a scenario where there's many kind of, quote, booms and busts.
That's right. I think that's the scenario that you could see some tightening and some success with inflation. Most people think inflation will naturally come down with base effects and possibly as some of the supply side issues get ironed out. You could see some success with inflation coming down, maybe 3-4%, that range. Then you start to see easing again. Then inflation jumps back up to the 5-6-7-8% range again. You get this cycle, as you say, a number of mini boom bust type cycles. Then you look back at it at the end of the decade and maybe inflation has averaged 4 or 5% instead of the 1 or 2% that we've had in the last decade. It's impossible to say what's exactly the scenario going to be. It's a very difficult task. The Fed's trying to get to this neutral or a bit beyond neutral tight, but nobody really knows what that means in terms of interest rates and the size of the balance sheet. You've got a lot of variables there. They're only controlling those two and then trying to influence financial conditions, which in turn influence the overall economy. It's a very difficult task. In all likelihood, the chances of a soft landing are going to be low. What makes that interesting from our perspective in the managed futures in the macro world is this could be a period of much more volatility in macro variables, which could be quite favorable for all of these strategies.
Let me shift you from you and I sounding like the typical folks on CNBC or Bloomberg that are saying, hey, what could happen, da-da-da-da. Let me shift you into your wheelhouse and try and take you back to a point in time where that wheelhouse started to develop. What I mean by that is, okay, you and I can lay out all these if-then scenarios about what's happened in the past, where things might go in the future. At the end of the day, you are a guy who is trying to help clients navigate this. And that means something concrete, something practical. I know you know something about some of the works that I've been involved in, some of the books and stuff. Likewise, I know you too. Even though we've not spoken, I know we've got a similar thinking on many fronts. Take me back to a point in time where you just lay out this economic scenario, but there's another side of you that said to yourself at some point in time, because you were influenced by somebody or someone, hold on. I don't want to make these predictions for the rest of my life. How can I trade these scenarios that can't be predicted? When's the moment? Where were you? What happened? How did you first come into the understanding of, let's say, a price action system, a trend following approach? When did this happen for you?
This is right back at the start of my career in the markets. I had studied economics in Trinity College here in Dublin and really enjoyed studying economics, macro in particular. There's a whole philosophy there, the different schools of thought, from Keynesianism to Monetarism, etc. Loved all of that. Then went from that world into the markets.
Give me a time.
This is the mid-90s.
Mid-90s, okay.
I was looking at the academic route, and then the investment banks back then used to do a thing called the milk round. So they come around and recruit graduates for trainee programs. I ended up joining Bank of America in London, did a graduate trainee program, and ended up sitting on the FX desk doing two things. I was assigned to the technical analysis division. I found that interesting. I was also trading in some prop trading as well. That's back in the time. Banks were happy to give green graduates out of college risk limits straight away. When I started that, you have an understanding of economics, but then it's a different thing translating that into how to make money in the market. It's one thing saying what should happen from an economic perspective to how did markets actually behave. I suppose it's probably my bent when there's something I don't know about or I'm trying to learn about it. I tend to go away and read lots of books and learn as much as possible. Around that time, would have certainly come across your work and read Market Wizards. That was very informative, reminiscences of a stock operator as well. A lot of people in that domain, and even macro traders, if you read the Market Wizards, very much highlighted the importance of the major macro moves and trading with the trend.
Did you have any TA, some technical analysis at the bank? I want to hear what that was, whether that was close to a trend following mindset or something else. But was this your influence, self-study?
It was, yeah. In the first instance, it was reading about what people who had been successful in the markets were highlighting. As I applied it, it became something that was comfortable to me, the idea of trading with the trend. Where I got to is I always had this macro interest, understanding why markets might be moving in a certain way, but essentially moved to a synthesis of technical and macro thoughts in terms of how I view markets. There's a couple of other things as I delved into this a bit more. One, on the desk I was sitting on, there was a quant trader, a guy trading a trend following model. As you can imagine, that was pretty early days in a sell-side bank to have a decent risk limit. That was an informative influence as well. My risk limit was part of that whole team. The manager was actually looking for somebody to trade more counter trends to be a complement to the quant trend following system. But my style tended to be trend following as well with a macro overlay. That was the initial period. After that, as we went through into the 2000 to 2002 period, certainly saw the strong performance across these managers. And I think that confirmed it, I suppose.
There's a skip there. You're at the bank, your FX desk, you're talking about a trader that had a quant system or a trend following system. And then you bring it up to 2002 and you could see all that great performance by some of these big names that you and I know. Something else happened in that intervening time period, I think. When did you first start to understand that it was an industry, or how quickly did you understand it was an industry? You saw the Market Wizards book. Was there something else, a further development before you got to 2002?
From sitting on a bank desk, we would see the flows as well. You became more familiar with the names in the market, the likes of maybe Campbell, people who were basically executing through the bank. There was that kind of familiarity with some of the names, not to a great extent, I would say, at that stage, just one or two. Probably as much when I left the sell side and migrated into working for a macro, a hedge fund in the early 2000s, formerly part of the CTA world, more on the macro side, that I became more familiar with the names and the return profiles. What was informative was that early period of that trading experience, feeling the exposure of trend following, how markets can trend over time. That was a really informative thing for me.
You mentioned Campbell. Did you feel like at that time you knew what a Campbell was doing pretty much?
Not to the extent of having been an allocator and looked at lots of different trend followers. No.
I know you know now, but
it was just that it was trend following. If you read Market Wizards, you get a pretty good perspective on the trend following mindset and the turtle mindset. I would have known it was in that whole philosophy, the vol sizing and the convexity and all of the ins and outs of it. Probably not. But I certainly would have known that their basic philosophy was to be agnostic to the fundamentals and trade with the trend.
To bring it back to my opening talking point or my opening salvo with you at the beginning of this conversation, what's so interesting about 2002, 2008, now 2022, not that those are the only periods where something like trend following strategy has done well. Those are three periods where it's done exceptionally well. People like yourself know. People in the know. But the average investor has no idea that there's this one style that's done exceptionally well during these three, albeit similar, interesting, but still different, quote, big events. It's excelled in all three. That's just an amazing story, isn't it?
I'm a bit surprised. I'm a bit stumped like yourself in that if you were to take a random sample of people involved in the investment industry, 100 people from around the world, what percentage would be very familiar with trend following and its return profile and what it can do in a portfolio?
Less than 1%?
I'd say a bit more, but it's low. It's definitely less than 20, maybe 10. I don't know. It's not a big number. It's surprising. It really came home to me. I did a CFA Harvard course a couple of years ago, maybe 60, 70 people, some fundamental equities, different backgrounds, but pretty good sample representation of the industry as a whole. That's where it really stood out to me. A lot of people were not that familiar with managed futures, trend following, and those types of strategies in terms of the mainstream in the investing community. It's a very interesting question as to why it hasn't taken hold when its performance and its return profile seemingly is very attractive in terms of an asset allocation, multi-asset portfolio perspective.
You mentioned technical analysis back in your early time and being exposed to that. I gave a presentation to a group in New York City, maybe a decade ago. I think it was called the Market Technicians Association. The room was like 600 or 700 people, and I was getting a lot of blank stares. At the end, I asked, show of hands, what percentage of you, these are the quote market technicians, what percentage of you know about trend follow? It was less than 10%. These were the folks that have got the word technician in their name. It's an interesting divergence to where so many people know about all the books you can buy on the shelf with all the cool patterns and quote predictions that might happen based on this chart squiggle or this chart wiggle. It's amazing how many people just have not been exposed to what you and I are talking about.
No, agreed. I think we're starting to see it a bit more. If you look across the US institutional space, a lot more public pension plans have been investing over the last decade, not just waiting for the event to happen and then jumping in. Certainly, in some instances, there has been an embracement of it. Equally, if you look across most asset allocation plans or multi-asset funds, certainly across Europe, if not the US as well, you don't tend to see much of an allocation to trend following. Typically, it's 50, 60% equities, 20% bonds, bit of credit, and then some hedge funds that won't really help you out in times of stress. It is still very much a niche part of the industry.
Do you ever ponder the idea that maybe it's not been helped by telling people, this thing's really nice, it's a really nice style, you should just get 5% of it, or you should just get 10% of it? You and I know people that have got their life in it. They've got 100% in it. Everyone knows what the risk profiles are. Everyone can go look at the performance track records. The question becomes, what type of performance track record does one want? For all we know right now, as I look at the NASDAQ, we could be in the middle of something that ends up looking like the same kind of NASDAQ drawdown or similar, worse, who knows, as we saw in '08 or the bottom of '02. If that's the case, it really becomes an interesting, at least philosophical exercise to say, what style? That window I'm stretching out is over 20 years. What style does one want? Does one want the typical 60-40 whatever with a splash of managed futures? Or do they say, I don't want to keep trusting the Fed and these interest rate rigged markets? It's an interesting thought process, isn't it?
It is an interesting thought process. I don't know how you get to a point where more people embrace it. From my experience working with clients, the people who are happy to stick with managed futures and trend following, very often they had some kind of favorable early experience where they saw it worked at one point in their careers, and then they have that staying power to stick with it when you get an inevitable drawdown. Whereas people have come in, seen the good performance after a period like this year or like in '08, then you get a couple of years where markets are choppy. Why are we in this thing? It doesn't seem to work. 2 years is, in the grand scheme of things, 2-3 years is not a long time. But if you're sitting there looking at it every day, it can feel like a long time. Trend following has that very interesting return profile. It's a very interesting is one word, I suppose, experience when you're allocated to trend. When you get the 2-year drawdown and in that period, other things are doing well. You have to be really comfortable that you understand why you're invested and why it makes sense as a strategy. Whereas if you haven't got to that point as an investor, it may be difficult to stick with it.
When do people start saying that the NASDAQ as a buy and hold asset has an interesting return profile now after 22 years of these booms and busts?
It's always the way that you find with these kinds of strategies that we're involved in. The bar seems to be that little bit higher. When equities are in a big drawdown, okay, they're in a drawdown, but the value is getting better. There is always that natural bias to be more forgiving of the drawdown. I don't know if that's something embedded, a structural behavioral bias that's difficult to overcome.
Baked into the cake, so to speak. Let me turn you this way. Put your professor hat on and let me pipe down for a moment. I lay out these 3 time periods, '02, '08, and 2022. These have been big moves in equities and commodity markets. Why has something like a trend following done well? If you were to explain to the novice or a bunch of grandmas on the elevator with you, this ultimately becomes what is a trend following strategy and trying to explain it. Why have these 3 time periods produced excellent trend following performance? Why is that?
People forget what trend following captures. Ultimately, trend following will do well in an environment where you get big moves in markets, where you get extended trends. Sometimes people say, oh, it'll do well with volatility, but it's not just volatility, it's directional volatility, or you might just call them big moves or dislocations. It's always important to remember that that's when trend following will do best. Why allocate to trend following? I think it's because that's the nature of markets. Markets go through periods of being somewhat in equilibrium, where the markets will tend to chop around for 1 or 2 years, or maybe even longer. Then you get a change in the fundamentals and markets have to reprice. When you get that repricing event, repricing doesn't happen instantaneously. It happens over a period of time. People have to rebalance their portfolios. They have to get out of one market. They have to get into something else. That process of repricing is what generates trends in markets. We saw that in 2002, obviously 2008. You went from an 2007 period where everything looked fantastic to 2008 into a financial crisis. That scenario, everything has had to reprice. Between 2020, 2021, you had an environment of ultra loose monetary policy, strong economy. To 2022, everybody's recognizing, okay, there's going to be a significant shift in the monetary policy backdrop. So that repricing triggers trends, big moves in markets. You can see that in the periods when trend following isn't working. If we take a step back to 2019, which you'll recall was probably the bottom in terms of trend following sentiment and behavior, lots of people after 2018 were saying, does this still work? It's broken. And you'd say, well, why is it broken? There's lots of theories put forward, like there's too much money in the space. These traders are being gamed by high frequency, that the market trends have become faster and trend followers are too slow. These were all theories that were put forward by people. And there was a general belief from a lot of people that I spoke to that the central banks could control the markets and maintain volatility, and we wouldn't see the kind of moves that we've seen. Back then, I wrote a paper, it was called A Market Environment for Trend Following, looking at why really trend following had struggled. You could quantitatively measure the number of big moves we'd had in markets. If you looked at the number of standard deviation moves for every market over the last year, looking at the major futures markets, one market out of the 55 we looked at had a one standard deviation move or more. Normally, that might be 30 or 40 of the market. It was a period where we didn't have big moves. It was very choppy. Naturally, trend following didn't do well. But as we've moved forward into 2022, where we've had much more big moves, significant expansions of volatility across interest rates, bonds, FX markets really moving in the last number of weeks, commodities, obviously. This is the kind of market environments that you would expect trend following to do much better in. An environment of dislocations, big moves in markets. There is another question of what causes that and what kind of macro backdrop do you get more of that? Sometimes it's an economic downturn, like in 2008, but it can also be an inflationary type environment like we're seeing at the moment.
The trend following traders are not trying to answer those questions.
No, they're not. It's a technique for managing risk in markets that will get you into positions that you know will benefit in a particular type of market environment. Namely one where things start to fall apart and markets start to reprice.
Some people out there might say that the word I'm about to use, I say, oh, Mike, you're just trying to make yourself sound good or something. But it's a very honest strategy because it doesn't require and it doesn't demand inside baseball or inside game or friends and family to help do things. I'm thinking, for example, to the fall of 2008. We already saw what happened in the summer. We saw Bear go away. We saw Lehman go away. I would surely think that if the powers that be did not take action in the fall of 2008, Goldman Sachs and Morgan Stanley and probably Warren Buffett would have joined the family of those that would have ceased to exist. Trend following doesn't get bailed out by anybody. It's literally somebody, a trader, a team, or a firm who's literally saying, I've got my capital here. I've got my rules. I'm going to go into the market system. Here are the rules I got to play by. I've got to hope that the exchange plays honorably. I've got to hope my brokers play honorably. Ultimately, my system, my approach is just me and my wits, so to speak. That's very different than so many strategies out there, which really seem predicated on inside shit.
Yeah, I think you're right. One of the things about trend following is trend followers trade lots of markets. They don't have necessarily a lot of insight on all of those markets.
They generally don't have any insight, do they?
They don't have any insight.
Right.
Exactly. Maybe that's what people don't like. It's like, do I really want to be long soybeans here? Or do I want to be long crude oil at these levels? The insight that trend followers have is the nature of how markets behave, that this is how the markets move, that they will tend to be choppy for periods. But then you will get these periods where you get these explosions in volatility and exaggerated trends. By constructing this rules-based strategy, you can be profitable, even though you don't have any particular insight on the fundamentals of any of the individual markets. So it's an insight about the nature of how markets behave rather than an insight about the fundamentals of any individual market.
You use the word behavior. I can think of Daniel Kahneman. Of course, he comes to mind, the leader of that whole wing of investor sentiment. You and I both know plenty of people that arguably, and not to take anything away from comment, but we know plenty of people with the same gray matter who could have arguably been given the Nobel Prize a decade or two before for living and breathing it in this world where they figured out these strategies to take advantage of behavior.
The behaviors are so embedded that even though people will learn about them and they're flagged, it's almost like there's an intellectual discussion about behavioral biases that happens separately to the behavioral biases themselves. Everybody will say, avoid recency bias, and I'm not going to be seduced by narratives.
Trend following is the best definition of what that means.
Yeah. At the same time, when people come to make investing decisions, obviously they're influenced by recency and fear and greed and all of those biases. It's very hard to get away from that, but that's where the opportunity is for people who follow a trend-based approach. It's that markets can, at times, be very sentiment-driven and push the markets to extreme.
You mentioned that you were thinking about the academic direction at one point in your life.
That's right, yeah.
That's where it gets so interesting, is that the ego check that so many of these quant trend traders have to do to not try to prove that they know what's going to happen, not trying to prove that they can see tomorrow. That's fascinating. You mentioned it earlier. It goes back to Livermore. Even though Livermore had a bad ending, he figured out a lot of stuff.
Yeah, I think you're right. Having been in this managed futures trend world for the last number of years, you go to events and panels and industry events, and trend followers are the worst people to have on it because they say, well, what do you think in the markets? And the answer is don't know. That's the reality. Sure, you can paint a narrative, you can paint a picture, you can say, well, the environment is looking better than it was last year. It looks like it might continue to be favorable. Who knows? That's not something that resonates with a lot of investors. People like stories about stocks.
When you say people, and you mentioned going to the conferences, you're ultimately talking about perhaps very qualified people, PhDs, the physics degrees, all this background. For some reason or another, and this could become an interesting argument, they either pick the side they're on because they like the way their bread is buttered, or they're just oblivious to what you and I are talking about.
I think you got different types of people. In the academic world, you've got some who just don't believe that these types of strategies, if you don't have insight in individual markets and markets are inefficient or whatever their bent is, that this kind of stuff can work. Or else you have people who just haven't had that exposure to it at some point in their career and never learned about it. Or maybe have just lacked the inquisitiveness, the curiosity to explore, well, why is it that the strategy has, as you say, done so well in that 02-08 period when everything else wasn't working? The data is there and it's pretty clear to see why these strategies have worked. People not invested obviously have different reasons for it, but they probably fall into a number of different categories.
Do you ever try to make any venture capital parallels to explain this style of thinking?
Absolutely. No, it is. At the individual portfolio management perspective, when you're trading, you have trend following portfolio, you make a lot of bets. Most of them will end up being small losses. You get some moderate winners, and then every now and then you'll have a big winner, just as you will with VC. You'll have out of 100 company portfolio, you might have 50 losers or 60 losers, 20 decent performers, 10 even better, and maybe a small number of really good performers. It's very similar with trend following that most of the trades will be losers. You might make small gains in some, and then every so often you'll get some big trends that come along, really nice setups where you get big volatility expansion and massive risk reward for that small initial outlay. There certainly are parallels with that.
One of the things that I find really interesting about this style of thinking, trading, this philosophy is the phrase or the word Bayesian. And I had a psychologist on this show a while back, Alison Gopnik. She had coined the term Bayesian babies, that when little babies are small, they kind of take this Bayesian approach where it's like, hey, I'm going to go this way. And if this way rewards me, I'm going to keep going this way. Oh, this way is not rewarding me. I'm going to leave that way. That is such a nice little connection to the trend following quant world. It gets back to David Ricardo. It's cut your losses, let your profits run. It's one of these maxims that goes back to the 1700s, 1600s. Who knows how far that maxim goes back, really, right?
Absolutely, yeah. It's an interesting perspective. But I think the challenge is that maybe a lot of people in the markets have views on all of those individual markets. And that's what makes it difficult. From a trend perspective, you've got to pay the highs and stick with it. Whereas if you have a view on that market, you might say, I don't really want to buy here. So that's probably part of it. That Bayesian, it's an adaptive mindset, isn't it? Let's see what's working. And if it's not working, we'll adjust.
It would be really interesting to see if in the not too distant future, let's say Mr. NASDAQ decided to go back to 5,000. Then it really does open up the hypothetical I'm having with you in this conversation, where you kind of look at everyone that's spent a career in academia or they've spent a career studying the fundamentals. If we end up with a scenario where equities do really go back on a big time drawdown, essentially leaves us with a 25-year window of going nowhere, that'd be quite fascinating if we get to that point. I keep wondering, will we ever reach a point where people throw their hands up, or will they just keep going along with the system, so to speak?
I think what we're seeing is that, again, it's another behavioral thing. People extrapolate the recent pattern and assume that that is the world order. In the last decade, we've had not a huge amount of volatility in markets. We had a few events, Brexit, the Trump victories, surprise events that triggered moves. We had volatility, obviously, in Europe around the debt crisis. Really, it was a decade of low inflation, low, moderate growth, not a huge amount of volatility in markets, and obviously massive quantitative easing and central bank management of the system. People assumed that would be the way forward for many years. If you have a longer term perspective on markets, what you learn is anything can happen, that the paradigm can shift. Who knows what the next paradigm is going to look like? If you went back 12, 18 months ago and said, I think US inflation is going to be 7-8%, people would have said, not a chance in the world. And now we've had it. If you approach it from the perspective of anything is possible in the markets, then it's a different mindset when if you approach it from the perspective of we're never going to see 70% drawdown in equities, or we're never going to see that, or we're never going to see that anymore. That was all in the past. If you have the perspective of all of that can happen because we've seen all of that before, and we can see things that we've never seen before in markets just by the inherent unpredictability and unstableness of markets because it's a group of humans trading it. Who knows what can happen in this marketplace?
Less than 6 months ago or so, Netflix was supposedly going to own Hollywood. Now Netflix is in the middle of a 75% drawdown. Things change fast in the big city. You're a guy that's seen a lot of professional performance track records. I've seen a few, at least in my trend following world, more than a few. I've found that data over the years to be terribly interesting for an assortment of reasons that I've talked about before. I'm sure you can even guess what I would say. I'm curious from your perspective, are there other styles of trading that have got this wide acceptance amongst traders for decades where you can go and look at these? I mean, look, some trend following traders are no longer around for retirement reasons. Maybe they didn't want to manage money. Maybe they didn't have great performance. But there's so many interesting track records going back a long period of time. There's a lot of efficacy there. What about other styles of trading beyond the buy and hold stuff that we can all look at? Are there other styles that have that performance track record on file with the CFTC, so to speak, that we can all look at?
There are obviously individual firms with that. The likes of Renaissance are the one that everybody will point to. There are certainly individual firms who have been in the game a long time and stood the test of time.
Do we have a good idea of what Renaissance does?
Not a good idea. I think people have some idea, but a good idea? No, I don't think so.
Which is an amazing thing for you to say. You've been around the block. For you to say that, you're not just a guy on the street saying that. One of the most successful traders ever with significant assets under management, and you're pretty much punting on what they do.
You can say it's in the certain domain of short-term trading, using a lot of leverage and all of that. In terms of what the signals are, or what gets them into individual trades, no, I think people are guessing when you get down to that level. In terms of broad categories of strategies, the parallel with trend following is value investing. It tends to be something that is backed up by academic research. It's something that can have long periods of being out of favor, but generally when it's about to be thrown out, it makes a comeback, which seems to have been the case in the last while as well. There's not loads of different strategies. It's not like there's an obvious one in the long-short equity world. There are other strategies that have been around for a long time that have a very predictable type of return profile, like carry type strategies that will have their time when they'll do well. But everybody knows that there will be the invariable, inevitable blow up with that type of shortfall strategy. In terms of things with the same robustness as trend following, hard to think of anything, to be honest.
You have spent some time in Asia, right?
In Hong Kong and Singapore.
How long were you in both?
I was there 3 years in total. Most of the time was in Hong Kong. It was about 2.5 years, and then a shorter spell, maybe 6 months or so in Singapore in the late 90s.
What was your perspective on these issues we're talking about right now? Did you find in that period of time when you were there, or even in the ensuing years, how people in Asia might view our conversation about these quant trend following strategies? Same mindset as Europe and America, or something different?
In Hong Kong, there was always that speculative mindset. Even where I was working in the bank, there was the active retail margin trading desk. Retail investors would have been very active trading FX. There's always that interest in speculation. Again, quant strategies, I'm not sure have they taken off to any massive extent. I think from what I hear about, they are growing in terms of China now with the Chinese futures market. It's not just foreign CTAs who are now looking to access those markets. There is a growing trading community and hedge fund community within China. Anecdotally, the investor interest tends to be quite short-term performance chasing. Again, this is just anecdotal from the people I speak to who are on the ground there. I don't think it's taken off as an institutional allocation like we're talking about, but there are CTAs developing, obviously, in Asia. It's probably in that category of being behind some of the other markets. The US with the public pensions being large allocators would be more to the fore, and other markets like Asia probably a little bit behind.
I've found that in conversation, whether the retail or the fund level, traders in Asia, it's baked in the sense that they don't trust the information flow remotely the same as perhaps in the States or Europe. I find that many of my associations in Asia, people seem to be more open to let me trade the price because I can't trust the news or I can't trust the government. I mean, look, I don't think I can trust the government in America, so I'm not trying to talk bad about any particular government. I have noticed that there seems to be a more openness to the idea that I don't have to know the fundamentals and I can trade price.
In terms of technical analysis and charts and all of that, you've always had that in Japan.
They love the candlesticks.
The candlesticks, exactly. In my time there was a lot of interest in the charts. Part of my remit was technical analysis, so there was that interest in the chart points, the charts, the chart patterns. Often that doesn't necessarily translate into an interest in investing in something that's systematized, like a trend following system. There seems to be maybe a bit of a disconnect in that respect, but certainly an interest in price action patterns, all of that stuff, and a strong interest in speculation, not just in the markets, but across many walks of life in China and Hong Kong.
If I was to imagine a horizontal line in front of me, and on the far left, I've got the fundamentals. In the middle, I have traditional technical analysis. And on the far right, I have trend following. Because it seems to me that traditional technical analysis, how so many people come to understand it, at least for the first time, it's not too different than fundamental analysis in the sense that you are using some information to then say XYZ will happen tomorrow or the next week or the next year, whereas trend following doesn't do that.
They have their origins in, I suppose, the same thing of looking at the price primarily. But typically, with technical analysts, people are still looking for people to make a call, at least to say, these are the key levels, and at this level is broken, etc. It still is very much forward-looking and predictive in nature, where technical analysis can be helpful as a trader in helping you formulate good risk-reward scenarios and helping to fine-tune entry points. And also, it's a tool of market analysis that can help highlight interesting things that are evolving. Certain sectors are outperforming. If you're starting to see breakouts, the classic one, if you're starting to see price breakouts, but that haven't been reflected with massive changes in fundamentals yet. I think technical analysis and charts are interesting. They can help flesh out the narrative. They help flesh out a perspective on what's happening. But it's one thing having that fundamental and technical to build the color, whereas trend following is a rules-based system for managing risk. They're slightly different in that respect.
You talk with a lot of people. Where are we today in 2022 as we're in the fifth month? Where are we in terms of investor psychology right now? You've probably got a better sense of this than I do. I can look at the bloodbath across certain markets and certain indices and whatnot. What's the feedback you're feeling from people? Have we hit anywhere close to the fear that we hit in October of 2008? I don't think we're anywhere close to that yet, are we?
No, I don't think so. I mean, there certainly seems to be a little bit of it around the last couple of days, Twitter and stuff like that. People saying, oh, get into cash, etc. But I don't think so. It doesn't feel like it's been a really crisis type move. It's felt more of a grind down. Even the volatility of US 10-year notes, not unusually high at the moment. It's been a pretty steady trend higher in yield as opposed to massive 1 or 2 day moves. Up until, I think, Thursday or Friday's move was probably large by historical standards. But in general, what we've seen over the last few months has been very steady and well contained. I think a couple of things. I don't think we're at a sentiment extreme yet. We could get a rally, but I don't think it's a real capitulation sense at the moment in the big picture. I don't hear anybody saying don't invest in equities going forward. We've been in a drawdown this last number of months. So really to get that sentiment shifted, you have to be in a multi-year period of underperformance.
Or one steep vertical down can cause people to change their underwear fast.
Yeah, it does that. But then people say, well, actually, now the value's in equities. Just got to close your eyes and buy it. The worst scenario is when you're not getting a positive experience, when you're not having a lot of days when the market's rising, when you're having lots of periods where the market's falling, it's in a drawdown, it doesn't appear to be turning around. That kind of environment dents sentiment much more. Obviously, with a short, sharp sell-off, people get hurt. If you look back to March 2020, you had that type of short, sharp sell-off. But then the market rebounded almost as quickly. It was almost like it happened so fast. Unless you were very active in managing your risk, you could easily have missed it and not really felt a huge amount of pain. I think from a shift in sentiment perspective, it'll take much longer. What we are seeing, though, everybody is saying 60-40 is dead. I do think that we will see more interest in alternatives, in macro strategies, and managed futures, etc. over time. It typically does follow positive performance. It's probably more on the fixed income side where people will look to rebalance. But in terms of risk assets, we're only in the early stage of sentiment being really impacted on that side.
Crypto, Bitcoin. I would love nothing more than for a stable currency, as how the biggest Bitcoin proponent would imagine it, stable currency outside of the purview of government. I think that'd be the greatest thing in the world to exist if it could exist. How do you see this? What's your feedback about the way crypto, way Bitcoin has moved forward so far? And what's the word that you feel coming from clients, friends, family, associates on crypto? Where are we in terms of its acceptance? A lot of young guys that have made a bloody fortune on it, but that doesn't necessarily have anything to do with wide acceptance.
That has been the point about Bitcoin that's probably been very disputed. If you go back 5 years, the view was invest in Bitcoin because we'll all be dealing in Bitcoin and buying our coffees in Bitcoin and transacting in Bitcoin. Every so often, a new platform would say, oh, we're accepting Bitcoin. I think it was PayPal a few years ago. And that was part of the rally. Obviously, we haven't seen that kind of adoption. More mainstream transactions have caught up in terms of being easier to transact with things like Revolut and stuff like that. The transactional nature of Bitcoin and crypto hasn't taken on. The narrative shifted to Bitcoin being more of a store of value and limited supply, etc. It can be a digital safe asset, maybe an inflation hedge. We saw the articles going around saying if you added 5% of Bitcoin to the 60-40 portfolio, what it would do in terms of great things to the portfolio. As we moved into this year, then there's been disappointment with all of that. The store of value argument, the inflation hedge arguments have been undermined. That said, a lot of smart money has flown into the space. A lot of institutional investors have embraced it.
Hold on. How do we know they're smart money or dumb money? How do we know? They could very well be smart money. Just to clarify there.
When I say smart money, people who have been successful in the industry, large hedge funds who have been successful trading markets in the past, have increasingly migrated into the space.
That was highly diplomatic.
I think there's two elements to that. There's one element is, well, the stuff is moving and there is opportunities to make money in multiple ways, not just from the long crypto beta type idea.
That's the kicker right there, what you just said. Things are moving. If things are moving, it's a liquid market. You can get in and out. Okay, hey, let's go, right?
That's exactly it. And I think that's why you've seen a lot of the macro community move into it. We've been talking about parallels for 2000. I think there is that parallel, that tokenization, digital assets, blockchain, all of this is very interesting technology. And you could see how that could disrupt traditional finance in terms of lots of different ways. The question is, how do you get exposure to that? Does that mean that some of these coins are going to go up over the long term or not? It's like back to 2000, are you going to be in pets.com or are you in Amazon? It's very hard to know. Structurally, there will be a lot of interesting stuff coming out of it, but how you play it, I don't know. I haven't been an advocate of cryptocurrencies or coins, but I do think tokenization and digital assets do have the potential to be very transformative for the financial and investment industry.
I'm a big fan of Breaking Bad, Better Call Saul. The director puts all these Easter eggs in his shows, and you just dropped pets.com. Some people aren't going to know what that is, but the sock puppet, it's just the quintessential brand ambassador, a sock puppet. I'm not going to hold you to it, but I think you just compared the crypto industry to sock puppets a little bit.
Dogecoin, it started off as a joke. Who knows? What I'm saying is that there's going to be winners and losers. Some of this stuff won't stand the test of time. Maybe some of it will, but very hard to say which. I'm not sure the coins is the way to express it. I'm certainly not an expert on the space. but I have been bemused by the ongoing rise. So not surprised that in an environment of tightening liquidity, higher rates, balance sheet adjustment, as the liquidity flows back out, that the most speculative areas of the markets you would expect to come under pressure.
Let's give a shout out to the younger generation in the sense that they have jumped into the Bitcoin, to the crypto, etc. Comparatively, in the last 25 years or whatever, you would get so many nervous Nellies, much older, talking about, oh, no, that trend following, it's too volatile for us. The Bitcoin enthusiasts are like, hey, man, we take 50% drawdowns and we like it. It's quite a generational divide, isn't it? Boomers and Gen X, some of the younger guys, they're just like narco gamblers. I'm not so sure, but it's pretty wild. Their attitude is risk on.
Is that just a function of what they've experienced over the last number of years? That things always bounce back? Does that change if you get a more prolonged downturn? That's when we'll find out. You're right. A lot of people holding these assets seem to be long-term holders, but only time will tell if you get into a really prolonged decline. People need liquidity if they're losing money in other assets. A lot of these things can look attractive when the price is rising, but if you have persistent downtrends, how attractive will they continue to look? Who knows? I'm not buying the dip in Bitcoin just yet, put it that way.
One baby final question. Would anything surprise you from the time we record right now to broadcast a few weeks out? Would anything surprise you in the markets right now? Or in your mind, anything's possible?
Pretty much. I mean, anything is possible. There are certain fundamental things that you just know that...
Could you imagine an 87 one-day move again?
Oh, for sure. Absolutely, it's possible. You say, could you have a 1929 scenario again? Well, no. 1929 was all about the mistakes from the Fed, etc. You can have mistakes again in the future just because there's more knowledge now. People thought they had more economic knowledge, but we've still managed to bring inflation back when people thought that wasn't really possible. Anything like that is possible from my perspective. 87 absolutely could happen again at some point in the future. I'm not saying it's going to happen in this round, but certainly you'd be mad to rule it out.
Alan, cool stuff. How many different issues did I take you to? You're probably like, oh my gosh, where's he going to take me next?
Not at all. No, pleasure chatting to you. I really enjoyed your work over the years. Great speaking to you.
Where can we send people? Where's the best website? I know you got the firm and everything. Is that the best place you want to send people? What's the URL?
archivecapital.ie is my firm's URL. I'm on LinkedIn, do a little bit on Twitter, more on LinkedIn probably. But any of those, you'll see what I'm writing about or talking about.
Alan, I appreciate you coming on. Hopefully we can do this again in the future. You're going to always have a perspective, and let's keep our fingers crossed and hope that something really exciting happens, because I need to update my trend following book with a new major event, like a major blow off, something really awesome. Other people are thinking, hold on, Mike, why is this awesome? Trust me, for me, it's awesome. I don't know about you out there, but I think for Alan, you'd be okay too. Hey, let's see what happens, right?
I look forward to seeing that when the update comes out, but I think we will see spectacular events. Who knows what they'll be, but there's a decent chance he'll be updating that book within the next few years.
Alan, take care. Have a good one in Ireland today.
Thanks a lot, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.